Let's get back to these numbers. We've had total vehicle industry sales up 9.4% year on year, and we highlighted earlier that on a month-on-month basis, vehicle sales have increased 4% as well. To what extent are we looking at this being a sustainable picture in terms of growth and the rate of growth moving forward, given the very uncertain economic situation that still presents itself globally, but in South Africa as well?
Yeah, Alishia, thank you. I think you described it in your earlier opening very well. There are a number of positive or drivers in the market that we believe will drive the sales or keep the sales at a level of somewhere around 10% for the year, and the expected growth into future years or the next 2 years around 9%. So in the vehicle industry, the replacement demand is one of the big drivers, and if one considers that we've had more than 2 million new vehicles sold in this industry over the past 5 years, that replacement demand in itself will be a big driver of sales going forward, as will the rental companies that are in the process of refleeting in the second half of the year, as is a sort of tradition. So we're pretty confident that sales for the year should finish up somewhere around 10% on 2011.
Okay, so take us through the kind of trend that you've been noticing, as the months go by. I mean, this month specifically in terms of the kind of sales that you're witnessing.
Yeah, look, if one considers that passenger was a strong performer in no matter how we measure it in August, the LCVs slightly off month on month, but still showing strong growth year on year. And Alishia, there are varying levels of stock issues in the industry, and it's ongoing. So month to month that differs, and in some months you may find that the sales are down, and the reason for that is a shortage of stock. So LCVs are particularly afflicted by it. Many of the entry-level vehicles are also imported to South Africa, and the availability of the more sought-after ones sometimes also impacting on what does get sold. In the heavies and buses, we still see almost 5% growth year on year, which is pretty strong. But in the recent months, we have seen a shortage of stock items, and particularly some of the heavy trucks.
With the current demand-supply situation that you're witnessing, what's your outlook on new vehicle price inflation moving forward? Because of course, exchange rate fluctuation is something that will come to bear as well.
Yeah, that is certainly a big factor, and the exchange rate is the factor that will determine the price increases. Currently, as we look at it, we are still in real decreases over the past 3 or so years. So new vehicle prices are very affordable, and that is one of the other drivers. I think, Alishia, also worthy of a mention is the fact that the numbers or large numbers of vehicles get sold into that entry-level type market, and there's an abundance of offers by the manufacturers with constant new entries into that segment of the market, which is also a strong driver of sales. The increasing petrol price, of course, not a good thing, but consumers will certainly, I suppose, look to adjusting to the vehicles that they buy based on the fuel prices going forward.
Earlier on in the show, we were talking about waning credit demand as well, and that will come to bear on something like vehicle sales moving forward. What kind of trend are you noticing in terms of, consumers extending their lease periods, keeping them locked into a contract for longer, for example, and fixed rate options as well on vehicle financing?
Yeah, you've again described all the issues very well. I mean, if one looks at credit appetite and you measure it to the number of applications that we receive month on month, and I can say that in August we saw an increase in the number of applications. We saw similar levels of approval rates, which indicates that the quality of customer applying has remained fairly consistent. We know what the record is of credit impaired records in South Africa. When it comes to fixed rates, after the last rate reduction, it certainly becomes a factor worthy of a consideration, because but then we said the same thing 6 months ago, Alishia. So we are probably very close to the bottom end of the rate cycle, and fixed rate definitely an option. for a customer, particularly in terms of locking in all credit so that the affordability issues don't become a problem if the upward cycle in interest rates does occur. So does that sort of cover what you asked?
Absolutely. Just before I let you go, very quickly, you highlighted the fact that you're seeing an improvement in the quality of guests and that most applications that land on your desk are being approved. Has there been an improvement in turn then of debt servicing costs and the ability of consumers to actually keep up with their payments?
Yeah, look, the debt servicing cost has seen a constant improvement over the months, driven largely by the low levels of interest rate. I didn't say that we've seen a large increase in approvals. What we have seen is a constant approval rate, which is in itself is a great positive. Because if you see a huge spike in the number of applications and a decline in your approval rate, then the two sort of counteract each other. So we've seen a nice solid increase in application count, and we're seeing a constant approval rate, which shows or gives us that constant growth into the market. There are some discussions I think that we can look at possibly in the future sometimes, and that is sometimes the growth in household credit balances, which has gone up to 8.1% from 7.7 a year ago, but it's largely driven out of the unsecured lending. And whilst the note also says installment lending, I've had a particular look at that, and out of vehicle finance, very small growth compared to the unsecured component.
Let's leave it